We saw the markets finish yesterday just slightly higher after Jay Powell's testimony. What does that indicate to you about traders' confidence in these cuts?
You know, what we were saying at the beginning of the year, the market was getting very excited, started pricing in 6 to 7 cuts at the end of last year. And some were saying if the Fed doesn't do these 6 to 7 cuts, we're going to have a really tough time getting gains in the market. We said it wasn't as much about how many cuts. It was the willingness to cut if there's weakness. So we were worried they were going to say inflation's top concern. We can't cut rates even if there's an economy weakening. He showed the flexibility. But we do actually think inflation is much lower than reality. When you look at the housing data, real-time housing's down 1%, but BLO shelters at 6%. You get some updates on that, but we think he should be cutting. But I think the data is coming in a way that will eventually allow them to start cutting probably in June.
Yeah, Jeremy, you've come to us with some alternative data on inflation previous times you had us here, or you've been here with us. Sophie, I want to come over to you. Agree with Jeremy's take that this just gave the markets the confidence that the cuts are coming? And in your mind, is that enough to keep this rally this year going?
Sure. I mean, there's no doubt really that cuts are going to be coming through. But I personally think there remains quite a disconnect about when the market is expecting that to happen and when it will happen. I mean, when you look at the labour situation as well, as much as, again, things are broadly moving in the right direction, we're still in a situation where the labour market is incredibly hot. When you start looking at the way consumers are still behaving as well, particularly, I'm just thinking about things like, a barometer I might use might be looking at Amazon's strength in the retail space, for example. The willingness to spend on discretionary items is still very, very hot. So I do think that there's still quite a way to go, and that's why they're sticking to the script on not committing to a timeline yet on when those cuts are going to happen. And in terms of equity valuations, absolutely. I think that we're in this kind of, I've said it before, I think that we're in this holding pattern, really, in terms of seeing any kind of meaningful gains until we get a clearer trajectory on that timeline.
Sophie, it's interesting you say that. I mean, valuations, they haven't really seemed to put pressure on the market so far this year. And now it seems like just more assurance from Jay Powell to the markets that these cuts are coming. We actually had Apollo's chief economist, Torsten Slok. He's been one of the voices saying there's a chance the cuts might not come. But you're still saying that valuation's an issue for this market?
I think in some corners, yes. I think we're probably over the worst of very severe jitters. But I do think that, yes, rather than looking at this through the lens of we're going to see the bottom fall out of prices, I'm talking more about monumental gains and further gains coming this year. I do think a lot of that is going to rest on the trajectory and when we start getting more meaningful sentiment coming out of the Fed. But that said, of course, we know that can change at very short notice. And I'm looking forward to April's earnings season with excitement and a little bit of trepidation.
Okay, a little bit of trepidation there. So, Jeremy, I'm going to come back over to you. You don't have any trepidation about looking overseas for opportunity. Right now, you like Japan. We've seen a big run up in the Japanese markets. A bit of a different story there. Totally different central bank situation going on there. Why is right now the time to turn to Japan when we've finally gotten the confidence from Jay Powell that there's going to be cuts this year in the U.S.?
Well, coming back to what our other guest just said, the U.S. 21 times earnings, it's a 5% earnings yield. The Nikkei also break out to all-time highs, 40,000. When we look at DXJ, it's our flagship equity product. It's got a 14 PE ratio, so 7 points lower than the S&P. It's been performing better than tech stocks in the U.S. It's got all these tailwinds behind it from the weak currency. Their central bank's still at negative rates, getting off to maybe zero. So very much different situation. You've got Warren Buffett, one of the classic value investors, continuing to talk about why you should buy the stocks, not the currency, which is what DXJ does, gets you 5% on top of that. So it's really a combination of valuations and just a new sentiment breakout to this 40,000 Nikkei level.
Jeremy, just for the audience's sake, you're talking your own book. The DXJ is one of a WisdomTree ETF. It's called the Japan Hedge Equity Fund. Sophie, I want to come back over to you. You're also looking overseas. We have an ECB decision coming up later today, and you're looking at Europe. You say the valuations there are pretty attractive.
Yeah, absolutely. And I think, we can't forget that arguably the growth trajectory outline isn't necessarily the most exciting, but I do think that Europe is harboring some really quite attractive names that are kind of being forgotten. I think particularly at the moment, one thing that all of this noise has taught us is that there remains a lot of uncertainty around, and what do you do in those times? And that is going back to basics. You know, there are some companies and broader, really strong sectors with incredibly wide economic moats. So I'm thinking about names like the telecoms, for example. They've got incredible dividend-paying ability. I'm thinking about defence, names like that. And I think particularly as well, if you hop over to the UK, as much as we do have some broad-based productivity challenges here, I would say, actually, when you start to pick away at the financial sector here, we have some really quite interesting options. A lot of the big European and UK banks, for example, are trading below the value of their assets. That is compelling to me.